In this video, I'm going to be showing you how I trade the Forex market. I'm going to be showing you exactly how I do that on the 5 and 15 minute time frame and how I get precise entries using Cluster 2.0. I'm also going to be giving you the indicator for free so you can try it out in the markets as well. So I'm now going to be breaking down the chart from a technical perspective. If you want to add fundamentals into your trading strategy, then I suggest watching my previous video here. You'll find it on my channel. We talk about how to analyze the fundamental side of the markets and how to implement that into your trading strategy. So what we're going to do now is we're going to load up US dollar against the Japanese yen as the currency pair that we're looking at today and analyzing. We're then going to break it down from a daily time frame, hourly time frame, and then a 15-minute time frame. I'm then going to show exactly how we utilize Cluster 2.0 to reduce our screen time, but also give us the potential entries that we need to enter the markets in the overall direction that we're looking to focus on. Okay, so we're looking at the US dollar against the Japanese yen chart. You can see that I've got two moving averages here on the chart. I've got the red 8 EMA and I've got the green 21 EMA. Overall, this is a very simple method to utilize what is the overall direction that the currency pair is moving from a technical perspective. Overall, the whole fundamental analysis is sort of weighed into that, so we can see exactly how that is from a midterm outlook. You can see that US dollar against the Japanese yen has been progressively moving to the upside. Now, if I want to break this down even further, we can simply draw a line on here of when did it start, this movement. You can see on the chart here from the 8th of January, it has literally been in the same direction on the daily time frame for that entire period all the way up to today. So 33 days we have been moving to the buy side. Yes, we've had some downwards movements within this period, but these are ultimately the opportunities that we're looking to take advantage of on a smaller time frame. Let's try to keep this as simple as we possibly can for you as a beginner, understanding where momentum on the long term is going. We now know that the market is ultimately moving to the upside. Now what we want to do is we want to have a look at the smaller time frames, such as the hourly, to make sure that that is moving in the same direction as the long-term outlook. This is known as multiple time frame analysis, also known as MTA. So now you may have noticed that the moving averages are different. We have the red 50 moving average and we have the green 200 moving average. The same principle applies here. Red above green is a buyer's market. That's what we're looking at. So we can see now on the hourly time frame, which is what I would call my mid-range time frame, is actually in a buyer's market as well. This means that our hourly is aligned with our daily outlook. This is a good thing. It means that we've got two time frames matching the overall direction that we want to be trading in. So we're now looking at the execution time frame, 15 minutes. You can see that red again is above the green, 50 above the 200, which means we have a buyer's market. This means we've got the execution time frame, the 15 minutes, we've got the hourly, and we've also got the daily outlooks all aligning with what we want to do, which means we want to take buys. That is from a short-term, mid-term, and long-term approach in this current market environment. Remembering that this is 100% technical analysis at this point. The next stage that we want to do is we want to find points of interest to enter into this market. Now this is where my indicator, Cluster 2, comes in, which I'm going to give to you for free, so stay tuned for that. But ultimately, let's start circling points of interest. Now, if you're going to buy something because your outlook is to the buy side, you don't want to be buying when price is high, you want to be buying when price is low, as long as the moving averages are still in that overall direction. So all I'm going to do now is simply circle on the chart points of interest. So the first point of interest that we can see is here. Price comes down to the moving averages and it sits in between the 50 and 200 and it's around this area here. You can see that quite nicely. Price then rallies up, comes down, back down to the 200 moving average, and then it rallies to the upside. These are what I call points of interest, where price is usually in between the two moving averages or around them consolidating. We can now see that price has gone up and come all the way down and the moving averages have crossed. You may have found a point of interest here before the moving averages have crossed. So this could also be an area of interest before it crossed over. Remember, we're not going to get everything right, but this is where reward to risk comes in. So overall, when we look at the chart, we've got 3 points that we simply highlighted on this one currency pair over the last few days. We have this area within here, we have this area within here, and then if you can't see into the future, you'd also say this point over here. Now, ultimately, finding these points of interest can be quite difficult when you're starting out because you don't understand how far of a pullback is required in order to enter a trade. So what we're going to do now is we're going to drop cluster 2.0 onto the charts to show you exactly what that looks like in this exact environment that we're looking at. So what I'm going to do is I'm going to go to Insert Indicators, and I'm going to go to Custom, and I'm going to put our cluster algo V2 onto the charts. Here we have it. We've now got the cluster 2.0 onto the charts. You can see the points where we highlighted were the points of interest. You can see the indicator also highlighted this point over here. And you can see a little bit up here as well. This is where bringing your common knowledge into practice alongside with an indicator helps you filter out those ones that you're not interested in. A rule of thumb for me is when I see price rally, I'd like to see at least a 50% pullback in a pips calculation before I'm interested in even entertaining to take a buying position. So if we look at the ones that I was interested in around here, this is all interesting for us because we could have looked at any sort of position within here of our cluster. And you can see the cluster indicator ultimately did very well. Now let's have a look at some of the times, because ultimately you want to be really trading in between main market hours. So for me, that is between the hours of like 8 AM to 6 PM. So let's see now which ones fall out of category based on that. So around here is around midnight. So I'm not interested in trading at midnight because the liquidity is going to be low in the market, the spreads are going to be wider, and it's not something that I want to entertain. Here is 9:45 in the morning. Fantastic, there's an opportunity there. This one here is 2 o'clock in the afternoon, also opportunity. So we have two different opportunities in here, which is fantastic. So this is our first position. Let's now have a look over here. You can see that this is again around 1:15, 2 o'clock in the afternoon. Perfect, that's fantastic. We're not interested in these ones up here. Why? Because we spoke about it, that we like to see a 50% pullback of the previous rally, which would be around about here. Ultimately filtering all of these 3 or 4 out. However, we then have these ones that do come into that category of interest. So now we've got this tool that shows us our entries, which is fantastic. The tool down here will actually show you where potentially you might want to get out. So I'm just going to make it slightly larger for you so we can see that and really simplify this further. So we said that these two areas of interest were areas that we'd like to get in. So ultimately, if we're buying, we want to be buying when that's in line, which it is. And over here, you can see that it's gone from green to red, showing you that you might want to get out, which is a perfect idea in this scenario. So ultimately, if we're looking to enter into any one of these, the first place that I would be targeting is the previous high. So the previous high up here is around 50 pips away, okay? What you want to do is just make sure that you're coming in just below that and keeping it nice and reasonable. You can see here there's 45 pips. So if we were sort of entered into the first trade here, rather than saying that we got the second one, because that would have been a perfect entry, let's say we took the first one. If we've got a 45 pip target zone, we want to divide that by 2 and make sure that we've got 50% stop loss. So around a 20 pip stop loss. So our stop loss would have been down around here, which is completely out of the way of any of the market movement during that period of time. Overall, the market goes up and it hits around a 41, 42 pips. It's actually slightly below our target. Now you could have either left that trade to pan out the way that you wanted to based on your strategy, or you could have seen here that it turned from green to red, and after these 3 candles up here, you may have looked to bank out here, banking you around a 1.5% profit margin instead of the full 2-to-1 that would have been achieved later on the next morning. So you can leave these trades to pan out. So that would have been a 2-to-1 profit, fantastic, or a 1.5 if you exited based on the indicator telling you to do so. Let's now look at the second entry over here. So the second entry over here, we're looking to enter in when the market comes down to the 200 moving average, fantastic. You can see down here as well, it was deep within that red zone, should we say. And we could have entered in anywhere around here, understanding that this was a pullback, because we've understood that we've got our short-term, mid-term, long-term trend all in line with what we're looking to achieve. So we can go into a buy position in any one of these candles sat around here from where we see the blue clusters forming. And ultimately, again, first place that we're going to be targeting on intraday trade is going to be the most recent high, which is around 35 pips. So on 35 pips divided by 2, we're looking at around a 17 pips. I ultimately like something a bit more than that. I'd like to have a minimum of 20 pips. And so ultimately we would have had it a bit further down. But let's say we just stuck with that simple basics there of dividing by 2. And ultimately we would have been looking to target roughly the previous high on a 2-to-1. The market actually spiked and you could have achieved a lot more than that with over 100 pips in this scenario. This was off the back of a news release, and it's completely fine to use the indicator in line with the markets, because fundamentally speaking, you've looked at the short term, mid term and long term. The worst case you're going to have is your 1% downside risk, and the upside of if the market moves off the news release in favor with the overall momentum that you're currently seeing, you're going to be able to bank large multiples such as 2-to-1s, 3-to-1s and 4-to-1s. And this is a prime example of that. So let's not be greedy. Even if you held it just for that 15-minute bar there, you would have actually pulled a 4-to-1 reward to risk. Over the previous trade, that would have given you a 6% gain from having a 2% risk, 1% on each trade. But let's just say that you picked up 2%. You could have held this trade for a lot longer as well. If you looked at it from an indicator perspective, it didn't turn red until up here. So you could have maximized your trade a lot further than the initial 2-to-1 if you're sitting there watching it. Now, we have 4% in the bag there from following the simple rules that we've set out in this video. Now let's look at the third one. We've ruled these out. For those that don't remember why we ruled them out, that I spoke about a few minutes ago, it's because we want to see a 50% pullback of the overall rally. So here you can see that we had 160 pips on the rally there, which means divide that by 2, we'd like to see 80 pips. 80 pips isn't until this one over here. So we would have been interested in this trade over here. So let's now fast forward. If we're looking at this trade, again, it meets the criteria. There's nothing wrong with that. Technically speaking, it is aligned on this time frame, the 1 hourly and the daily. So we will stick to our rules, and we would have gone into a buy here, targeting the most recent rally. I wouldn't go for this one. I'll probably go for either the mid one of 50 or potentially that one up there of 65, giving us around a 30 odd pip stop loss. 27 pips, we probably got stopped out there. I would say that 29 pips, let's be fair, I would say that was a loss, and the trend just switched over and changed direction. So if we review this, using this simple analysis tool on a very basic Forex trading system, we would have got 2 wins in the bag there with a 4% gain, and we would have lost on that last one there, giving us a net 2 wins, 1 loss. The 1 loss, we lost 1%. On the 2 wins, we bagged 2% gain on each trade. So 4% gain with a 1% loss gives us a net 3% overall performance. This is exactly how I've been trading for over the last 10 years. Obviously, I've been utilizing fundamental analysis and having a full 360 approach, but this is a very basic way that you can get used to the markets. If you want to try out using Cluster 2.0 on your charts, download it in the description and enjoy it, chuck it on your charts and let me know your feedback in the comments. Don't forget to thumbs up, comment and subscribe.